So if I buy a share of a stock trading $100 and I want to buy 10 shares, that's $1,000. I'm actually going to spend the entire $1,000. I don't want to use leverage. I don't want to worry about getting a margin call if the markets go lower. And that's just the way I operate. But again, people today with margin accounts at brokerage firms can still leverage the marketplace, but nowhere near as great as they could before the stock market crash of 1929.
So what are some recent crashes?
That's a great question because I don't think we'll ever be able to eliminate crash. Now, how do we define a crash? They're defined in many different ways. Some people think it can be a percentage move in a very short period of time. Some people define it as a percentage move within a period of time. But some of the more recent crashes, even after the 1929 crashes, in 1937, in 1 year alone, the market lost over 37% because the depression really wasn't over and people were more worried. So there was a lot of selling of stock. After that, we really didn't have very many large, what we'll call market events or big moves until 1973-74. That's when we had the oil crisis and the resignation of a disgraced president. And over that 2-year period from 1973 to 1974, the stock market lost over 40% of its value in that period of time. Now that wasn't the last crash either. In 1987, 1 year after I entered the industry, we had a 25% stock market crash in one single day. The biggest one-day percentage move ever in the stock market.
Wait, I just have one question. What happened to you when you were working in the industry when that happened?
Well, I was brand new, so I was fresh out of college. It was maybe about a year after it, and being in a new job, I didn't really have any my own money to invest in the stock market, so I kind of sat there and watched in amazement. I knew it was a big deal because my older colleagues were watching the market, and no one could understand why was this thing falling so fast, what was going on. True, 1987 had been a great year for the stock market, but there was really no indication or event that was leading anyone to think that there was necessarily a crash on the horizon. There wasn't a tremendous amount of leverage in the marketplace, so it really was unexpected. But without getting too technical, what happened was an event called portfolio insurance. So as the market started trading lower on that day, there was a lot of programs which kicked in that would automatically start to sell stock and stock index futures if the markets traded down by a certain level. Well, that selling pressure created even more selling pressure and even more panic, which caused people to come into the market very quickly and sell their shares. So it was a huge move in one day, but it would recoup that entire 25% drop, I believe, in less than 1 year.
Okay, so what happened after that was the next big crash?
Well, the next big one was the NASDAQ bubble, the technology bubble. The 1990s was another tremendous decade for the stock market. Tremendous prosperity in the economy. There was a technology boom, the advent of the internet, and people thought, this is the next big thing. And it really, today even we know it to be the next big thing. The internet was transformational. But again, people got crazy with buying stocks. They were even buying stocks of technology companies which weren't even generating any profits. They were still operating at a loss, but people kept buying these stocks because they believed that this was the easiest way to get rich. This was transformational. And so the NASDAQ, which is one of the three main markets out there, you have the NASDAQ, which is more technology related. You have the Dow Jones Industrials, which is the 30 large components within the stock market, but also comprises industrials and technology and consumer goods. And then you have the S&P 500, which is really the benchmark today. It's a benchmark of 500 of the largest, most heavily capitalized United States stocks that there are. But to answer your question, with the NASDAQ, it rose to unsustainable levels because there was this euphoria of buying. And once you run out of buyers, meaning that there's no one left to buy, the market starts to head south. And so over a period, I believe, of 2000 to 2003, a 3-year period, the market lost approximately 30% of its value as people began to sell. Now, that wasn't the last crash. During the 2000s, we had the housing boom. And the housing boom was very similar to buying margin on stocks in the 1920s. People were able to put down very small amounts of money to buy homes that they necessarily couldn't afford. People were being issued mortgages that they shouldn't have been issued. Rules had changed, so people weren't required to provide documentation demonstrating that they could afford to buy the home. There were what's known as called liar loans. Mortgage brokers and bankers would issue mortgages just based on what you told them you had in income or assets without verification. And so we had the housing market rose to tremendous levels, and that in turn caused a crisis within the housing market, which bled over into the entire financial services industry. And it really accelerated in the fall of 2008. Some of the biggest and oldest investment banks of the world collapsed and went out of business. You had Bear Stearns collapsed in the spring of March 2008. Lehman Brothers collapsed in the fall of 2008. And all of the major banks were in tremendous trouble. In fact, the government had to come in, and as we know, and bail out some of the biggest banks by ensuring that they stayed in business. If you have the entire banking industry collapse, you can't have a functioning economy. And so between the fall of 2008 and March of 2009, actually March 9th was the actual bottom of that move, stocks lost over 50%. And again, similar situation. People who own stocks, they got scared, they wanted to sell, which caused other people to get scared and sell. Some people had to sell stocks they owned because they had to pay mortgages, and it finally bottomed out in 2009. And at that point, no one ever really knows when the bottom is. At that point, I remember even myself thinking, how much lower can this actually go? But that's really when people start talking about, we're going to have another 1929 type crash. We're only down 50%. In the 1929 crash, we know that it went down as low as 89% by 1932. So no one really knew that, where the low was going to be. But, investing in stocks is one of the most counterintuitive things that there is. There was never a better time to buy stocks than there was in March of 2009. In fact, even Warren Buffett in late 2008 wrote an article that, now is the time to buy stocks, not when they're going back up. It's like buying a piece of America on sale, as he likes to say, and he was right. Now, he wrote that article, I remember, I think in November of 2008, so his timing was off a little bit, but he's never been a market timer. But the lesson from this is that when you get big movements downward in the United States stock market, those are some of the best buying opportunities you will ever see, because if you believe in America and you buy good American companies and you buy them when the prices are lower and you're willing to hold them for long periods of time, over time, and I'm talking not a month or a year, even 2 or 3 years, but if you're willing to and able to hold those stocks for 5, 10, 15, 20 years, over time you should do very well.
Okay, thank you for coming. Yep. Thank you for sharing with us.
Oh, it was very much my pleasure. I enjoyed it, and good luck with your project, Josh.
Okay.